Hello students, welcome to my channel again. Today we are going to talk about another lesson, the very important topics in financial management, which is known as the basics of capital budgeting. What is capital budgeting? Capital budgeting is the process of acquiring the fixed assets or process of investment in capital projects. The characteristics. There are various characteristics of capital budgeting. The first and important point is capital decisions are not easily recoverable. And the second characteristic is capital budgeting involves in substantial amount of money. So when we talk about the capital budgeting, the management or the firm is making large number of investment, or we are talking about not in hundreds and thousands, we are at least talking about millions of monies. So capital budgeting decision is not flexible. The last one is effective capital budgeting may increase the market share. Capital budgeting process approval of Now let's have a look the capital budgeting process. At the very first stage, the first step is the generations of investment proposal. So management or the team of the high level of people, they will make a decision that they will make a document. It is called investment proposal. The second step is estimations of cash flow for proposal. So how much cash is to investment, how much cash flow we generate from, and what is the cost for year or monthly. That is estimated in the second stage. And third stage is the evaluations of proposal. So again management will management or finance team or accounting teams, whatever the finance team, whatever it is, the finance team will evaluate the proposal. And lastly, the approval of proposal. So the whole the boss of the company or CEO of the company, executive officers of the company or CEO of the company will make it approval of the proposal. Types of budgeting. Replacement project. The first type is independent project. What is independent project? What is independent project? In this type of project, the approval of one kind of project does not have any kind of impact on other project. So they are totally independent variables. The dependent projects. What is dependent project? For example, let's take one project cannot be independently work without the executions of another project. So they are dependent on each project. That is called dependent projects. Thirdly, mutually exclusive project. The mutually exclusive project, you have to choose only one project over another project. So you cannot choose 2 projects or 3 projects together. So there is only one project is to be chosen. The another is replacement project. Sometimes the machines or plants or other kind of project, their book value becomes at the end of the year 0 because of the wear and tear. So in that case, those kind of project needs to be replaced by the new one. That kinds of project is called a replacement project. The third one is expansion project. The expansion project happens when the demand or the market is growing in the consumer market. So a company might have to expand their market worldwide or locally. So they will have to expand their market. In that case, the project is taken as an expansion project. And the last one is diversification project. What is diversification project? When the company is really doing good all over the world, for example, their product or capacity should be expanded in the diversify or the various kind of project. In that case, the diversification project is taken place in the company. Now let's have a look the different kind of capital budgeting decision techniques. The first and most famous techniques is payback period. What is payback period? This is the traditional but important method of screening the projects. It is the expected number of years required to cover the investment of the projects. So what is the decision rule? How do you evaluate the project? There are 3 conditions. The first one is a project with payback period less than the set recovery time is acceptable, and vice versa. Second, in the case of independent projects, all the projects with payback period less than set recovery period is accepted. And the third one is in case of mutually exclusive projects, the project with shorter payback period is selected. Now let's have a look the formula. Payback period is equal to initial cost divided by annual cash flow, or I is equal to CFA. This is in case of the equal number of cash flow for each year. For example, there is a 10,000 cash flow for coming five years. Then this is for equal number of cash flow. So let's have a look. Uneven cash flow, or there is cash flow every year. The cash flow is different. For example, in year 1 it is 10,000, in year 2 it is 15,000, and so on. So there is a differentiation between cash flows. So payback period is F minus 1 plus IF divided by CFF, where and F minus 1 is equal to number of year prior to full recovery of investment. IF is equal to uncovered cost at uncovered start of full recovery period. Then CFF is equal to cash flow during full recovery year. Now let's have a look what is the merits and limitations of the payback period. Firstly, it does not consider all the cash flow of the project. So it ignores the cash flow after the recovery of original investment. Secondly, it doesn't take the time value of money and the risks of the project into considerations while evaluating the projects. And finally, it doesn't tell us how much wealth a project adds to the wealth of the shareholders and how much a project yield over the cost of the capital. So the decision taken on the basis of payback period isn't consistent with the wealth maximization goal. Now let's have a look one example here. I have a question here. The question is, the upper row is cash flow of project A and the row second is cash flow of project B. The year is from 0 to number of 5, so we know that this project is clearly 5-year project. And the cash flow for the project A, if you look, it is 10,000. That may be the initial investment, which is 10,000 for both of the projects, and the 3,000 for each number of year. And for the project B, the cash flow is 1,000 for year 1, 2,000 for year 2, and so on. So there is a differentiation between the cash flow every year. So we need to remember that the first one is the project A is cash flow is same for the year, for the all of the throughout the year. So we can simply calculate its project A since the cash flow is even, we know that payback period is equal to initial cost divided by annual cash flow. So what is the initial cost? I said 10,000 pound. It is shown in the bracket or in minus because this is the initial cost for the project. So, and the annual cash flow is 3,000 throughout the year, end of the year. So it's 3,000. Simply divide 10,000 by 3,000, we get 3.33 year. So payback period is 3.3 year. So that means it takes 3.33 years to cover the cost of the project A. Let's have a look at the project B. Since project B, since the cash flow is uneven, this is quite complicated. We can simply make cash flow and cumulative cash flow. Here is, we know, 0, 1, 2, 3, 4, 5. So in year 1 the cash flow is 10,000. So in year 1 the cash flow is 1,000. So the cumulative would be minus 10,000 plus 1,000, that gives minus 9,000. And year 2 it is 3,000. Year 4 it is, in year 3 it is 4,000. Year 4 it is 5,000, and year 5 it is 6,000. So let's make a cumulative cash flow here. Minus 9,000 and 3,000 is minus 6,000. Minus 6,000 and 4,000, that gives you 2000. So minus 2 and plus 5, that gives you 3000. Then in the year 5 we get 6 plus 3 is 9000. So we need to find out at what year the cash flow is the cumulative cash flow is positive. That means in year 4 the cumulative cash flow is positive by 3000. So that means just before that, in year 3, just the beginning of the year 3, our project starts to give the positive cash flow, which is in year 4. So the payback period is NF minus 1 plus IF divided by CF. NF is the number of years prior to full recovery of the investment, which is year 3. IF is uncovered cost of the start of the recovery year. IF is uncovered cost at the start of the full recovery year, which is 4000. This one. Then the CFS is cash flow during the recovery year. So cash flow during recovery year is 5000. Let's divide 4000 by 5000. We get 0.8. That means 0.8 years is the payback period. Now let's have a look the decision criteria. What is the requirement here? The requirement is the required payback period year is 4 years. So that means both any project that is less than 4-year payback period is accepted. For the project A, the payback period is 3.3 years, which is still below the 4 years, and the project B is 3.8 years. That means nearly 4 years, but still less than 4 years. So both project is less than 4 years. So both project is accepted. So decision: both project are accepted if they are independent to each other. 1. And for 2, for the 2, what will be your decision if there is project, if these projects are mutually exclusive? So we have to choose one of them. That is the main concept of mutual exclusive. We cannot take both of the project. So for the project A it is 3.33, and for the project B it is 3.880. So that means project A will be accepted if accepted because we need to give the reason as well, because it has shorter payback period under mutual exclusive method. So hello students, now let's have a look at another method which is called the discounted payback period. Previously we have done only the payback period, but this time we are doing with the discounting rate. The question is same like there, only in project B the cash flow is different. In informations it is given that make a decisions based on the independent and mutually exclusive project, and the required rate of return is 10%. Let's make year second column project A in pound, project B unit is pound. Then the present value interest factor is at the rate 10%. Then the column here, discounted cash flow project A and discounted cash flow project B. Now let's put all the value here. Here is starting from 0, 1, 2, 3, 4, 5. Then cash flow for year 1 for project A is minus 10,000. For project 2, B also it's minus 10,000. And for the project A, the cash flow is equally distributed. That means 3,000 for rest of the year. 3,000. For the project B, the cash flow is uneven. So in first year it is 1,000, second year it is 2,000, third year 3,000, fourth year 5,000, and fifth year 6,000. Then this column, if you remember that, we need to have a look the present value interest factor at 10%, that we find in 0 years it is always 1, and year 1 it is 0.9091, in year 2 8264, and year 3 0.7513, and year 4 it is 0.6830, and year 5 we get 0.6209. So let's multiply one by one. So this column is for project A, so the cash flow is 3,000. If we multiply minus 10,000 by 1, we still get minus 10,000, and 3,000 multiplied by 0.91, we get 2727. If you multiply 3,000 by 0.82, we get 2479. Multiply 3,000 by 0.7513, we get 2254. Then multiply 3,000 by 0.6830, we get 2049. Then lastly, 3,000 multiplied by 0.6209, we get 1863. Now let's have a look the project B. Project B is still 10,000 in year 0. So multiply 1,000 by that, we get 909. Let's multiply 2,000 by 0.8264, we get 1653. Multiply in year 3, multiply 3,000 by 0.75, we still get 2254. 5 years, in 4 years, cash flow is 5,000. 5,000 multiplied by 0.6830, we get 3415. Lastly, 6,000 multiplied by 0. Cumulative discounted cash flow for project A. Cumulative discounted cash flow for project B. Let's accumulate. For year 0, the cumulative is minus 10,000, and year 2, if you look at the project A, this is the discounted value. So we deduct 2727 from 10,000, then we get 7273, and let's deduct 2479, we get minus 4794. Then year 3, we still get, if you deduct 2254 from 4794, we still get 2540 minus. Then let's deduct 2049 from 2540, we get 491, still minus. And lastly, let's multiply we deduct 1863 from 491, so this time 1372, the value is positive. Let's do same for the project B. For project B as well, the cumulative cash flow in year 0 is 0. It's 10,000. So discounted cash flow in second year, in first year is 909. So cumulative would be 9091, and year 2, the discounted value is 1653. We get here 7438 minus 738, and we still deduct 2254 from 7438. We get 5184 in minus 5. So we deduct 3415 from minus 5184. Then we get here the value of minus 1769. Now lastly, we have a discounted cash flow for project B in year 5 is 3725, and we deduct this amount from minus 1769. Then we get the value of a positive value 1956. Now this is the final point we need to do. Project A, discounted payback period is NF minus 1 plus I divided by DCFF. For the project A, the value is going to be positive only in year 5. So the minimum payback period is 4 years here. 4 in the year 4 we have got the discounted payback period, cumulative discount payback. The discounted amount for year 5 for project A was 1863. If you divide 491 by 1863, we get the value of 0.26. In this way we get 4.26 for the project A. Same for the project B. Discounted payback period is for the project B as well. The value is only positive in the year 5 over here. So that means the minimum payback period is also 4 years. we need to the I is 1769. The DCF for the project B is 3725. 3725. So 4 plus, if you divide 1769 and we get the value here is 0.47, then here we get 4. If you add up these two, then we get 4.67 here. Now let's have a look the decision criteria. What is decision criteria? The decision criteria for this is the minimum payback period was 4 years. If you remember the previous question as well. So the minimum payback period for this question is also 4 years. So for both of the project A and B, the minimum payback period is more than 4 years, because for the project A it is 4.26 and project B it is 4.67. So on the basis of the question, we will reject both of the project because it is more than required minimum rate of required minimum period for the payback period. So we need to completely reject both of the project. But if we have to look, the best option between these two is project A has got the lower amount, lower payback period. That means we can make our profit quite quicker than project B, because the payback period for project A is 4.26 year and the project B is 4.67. So slightly project A is good project. So if we have to choose in between those two, in between these two projects, we will accept project A. Students, now let's have a look another very famous method. The method is known as net present value method. Net present value is widely used discounted cash flow techniques. It is the difference between net present value of the cash inflows and outflows. Mathematically, it can be expressed as net present value is equal to CF1 1 plus K1 plus CF2 1 plus K2 plus CF1 1 plus K power n. And lastly minus CF0, where CF1 is equal to expected net cash flow at period 1. CF0 is equal to initial cash outlay, then n is equal to number of life, and finally K is equal to cost of capital or discounting rate. Now let's have a look decision rule and its ranking rule. Decision rule is in the case of independent project, all project with positive net present value are accepted and vice versa. So all project that have got the negative value will be accepted. For the negative value it will be rejected. And rule number 2, in case of mutually exclusive highest net present value will be accepted. So in case of mutually exclusive project, only the net present value that have the highest as compared to project number 2 is accepted. So these two are the main decision rule of the net present value method. Now let's have a look at the same problem. Now another formula. Additionally, we can find out net present value is equal to also in case of equal number of cash flow each year, net present value can be calculated as annual cash flow multiplied by present value interest factor NUT, cost of debt and year minus initial outlay. Or investment. Now let's have a look the practical example here. We are taking the same example, project A, cash flow is equal to £3,000 for 5 years, and the cost of debt is 10%. Now let's find out, as the project A, the cash flow is 3,000 for another 5 years, so we can use the equal number of cash flow each year formula. That is, net present value is equal to annual cash flow multiplied by present value interest factor NUT, cost of debt, and minus cash flow 0. We know that cash flow 0 for this project A was £10,000. So annual cash flow was 3,000. If you look in the financial table, the present value interest factor NUT is cost of debt is 10% and number of year is 5 years, and cash flow 0 is £10,000. So 3,000 multiplied by what do we get the result here? We get the result here for 3.7908 minus 10,000, 11,372 minus 10,000, then we get finally here 372 pound per project. This is positive value. So now let's compare with project B. We know that for the cash flow for project B is 1, 2, 3, 4, 5. Cash flow and present value interest factor at the rate 10%, present values. In year 1 it was 10,000, and year 2 it was 1,000. In year 1 1,000, in year 2 it was 2,000, year 3 it is 3,000, year 4 it is 5,000, and year 5 it is 6,000. So present value factors are 1 for year 0, 0.9091, 0.8264, 0.7513, 0.6830, and 0.6209. Now let's find out the present value. So minus 10,000 multiplied by 1 is minus 10,000. Multiply 1,000 by 0.91, we get 909. 2,000 by 0.82, we get 1653. Then this one we get 2254. In year 4 we get 3415. In year 5 we get 3725. So total present value is, so net present value or NPV we get here is, we add up all of this positive and deduct the negative one, then we get the final value here, pound 1956. Decision rule: in the case of independent project, all project with positive net present value are accepted. That is the first rule. But we have to choose one project. So both of the project A and project B has got the positive net present value. We can see here. And in case of mutually exclusive project, highest net present value will be accepted. That means highest net present value is for project B, because net present value for project B is 1956 and net present value for project A is 1372. So clearly project B is to be accepted if the decision rule is based on mutually exclusive method. Students, now let's have a look the merits and limitations of net present value method. Merits or its benefits or its good points. First, this techniques considers the time value of money. Second, this method takes account of all the cash flow occurred during the project life cycle while making decisions. And thirdly, this method is consistent with the objectives of the maximizations of shareholder wealth. What are the limitations? Limitation: first, the method is based on the expected cash flow of the project, but it is very difficult to forecast the cash flow of with desirable accuracy due to the presence of uncertainty. Secondly, the cornerstones of the project is discounting factor or discounting rate. It is almost difficult to determine the appropriate discount rate applicable to the project under considerations. And thirdly and lastly, in case of project with unequal lives and budget constraint, much caution has to be taken while applying the decision rule method. Look, another method, very famous method, which is IRR or internal rate of return. What is internal rate of return method? It is the discount rate that cash inflows equal the value of the cash outflow of the projects. And in case of the project with conventional cash flow, this is the discount rate that equals the present value of benefits with the investment outlet of the capital projects. Mathematically, IRR is CF1 divided by Y plus IRR power 1 plus CF2 1 plus IRR power 2 in this way CFN 1 plus IRR power n minus CF0. It can be expressed as n summation Tn CF1 divided by 1 plus IRR power t minus CF0. IRR for even cash flow, we calculate IRR is equal to lower rate plus present value interest factor NUT at lower rate minus payback period divided by present value interest factor NUT at lower rate minus present value interest factor NUT higher rate, and obviously higher rate minus lower rate, where LR is equal to lower discount rate, SR is equal to higher discount rate, present PBIFA LR is equal to, we know that present value interest factor NUT at lower rate and present value interest factor NUT higher rate is equal to, same like that, present value interest factor NUT at higher rate. Then PBP is equal to payback period. Now let's have a look the IRR rate for uneven cash flows. Now let's have a look the IRR for uneven cash flows. We have previously done the IRR rate for even cash flow. There are some steps that need to be followed to calculate for IRR for uneven cash flows. Step 1. Sum of the annual cash flow of n, divide it by n to find out the fake annuity, and divide initial cash outlay by the fake annuity to find out false payback period. Find out the discount rate for initial by trial looking at the present value interest factor table for nth period. Step 3. Based on the pattern of cash flows, adjust the closure discount rate calculated in step 2 if cash flow in earlier period of the project is greater than the average cash flow of the project, and try out with discount rate less than that of the discount rate worked out in step 2 if cash flow in earlier period is less than the average cash flow of the present. In step 4, Step 3 shows the directions of the IRR. The positive net present value shows that the IRR is higher than the discount rate. So try out with higher discount rate. If tried discount rate result in positive net present value. The negative present value shows that the IRR is lower than the tried discount rate. So try out with the lower discount rate. Repeat this step until you get negative net present value and positive net present value of the project under consideration. And step 5, once you get negative net present value and positive net present value of the project, calculate IRR by using following equation: lower rate plus CF0 divided by present value lower rate minus present value higher rate multiplied by higher rate minus lower. PVLR is equal to present at lower rate, PVR is equal to present at higher rate, CF0 is equal to initial investment. Lower rate plus net present value lower rate, net present value lower rate minus net present value higher rate multiply by higher rate minus lower rate, where value NPV/LR is equal to net present value at lower rate and NPV/LR is equal to net present value at higher rate. Now let's have a look the decision rule or criteria. How do you make decisions to make a choose between various projects? There are two decision rules. The first one is accept an independent projects with IRR exceeding cost of the capital. Secondly, in case of mutually exclusive project with higher IRR is accepted because project with higher IRR contributes more to the wealth of shareholders. So justifications. Why do you take the decision rule? Because project with IRR less than cost of capital used to finance the project hurts the shareholders' wealth. And if such project is accepted, cash flows generated by the project are not enough even to pay off the cost of capital. So shareholders have to make up with the shortfall with cause the stock and this causes the stock price to fall. This is the reason why we reject the project with IRR less than the cost of the capital. Then what is the merits of this method? The first method is, as we know that it considers the time value of money. Secondly, it is consistent with value maximizations of criterion. And thirdly, easy to understand, communicate to the management and shareholders. And its limitations. The first one is multiple IRR. Method gives us multiple IRR when cash flow are non-normal. Secondly, conflicting decisions. IRR may give decisions conflicting to the decisions based on the net present value in case of the mutually exclusive project. And lastly, it violates value additivity principle. What is value additivity principle? if we know the value of the separate project accepted by management, we can calculate the value of the firm by adding up those projects, but it totally violates this principle. A previous example, the example is cash flow of project A, 3000 for all 5 years cash flow, and for project B, 1000, 2000, 3000, 5000 and 6000 respective way, and the cost of capital is 10%. The question is asking, make a decisions for project if independent or project is mutually exclusive under IRR. So now let's follow the step. Calculation of IRR of project A. Step 1, which is payback period of project A, which is payback period is equal to initial cost divided by annual cash flow. We know that initial cost is 10,000 pound, 10,000. Then annual cash flow for project 1 is 3,000 for all the 5 years, so that means 3,000 is here. Then we get value here, payback period 3.333 years. Now let's find out the discount rate for interpolation. Step 2, discount rate for interpolation. How do we find discount rate? This 3.33 years, if you look in the present value factor annuity across the 5-year period, so number of period is 5 and year is 3.33 years, that this 3.333 lies between 3.3522 and 3.2743. so that means we have two present value annuity factor. So let's find out the actual lower rate plus present value interest factor annuity at lower rate minus payback period divided by present value interest factor annuity lower rate minus present value interest factor annuity higher rate multiplied by higher rate minus lower. This is 15% and this is 16%. This 3.3522 lies in 15% and 3.2743 lies in 16%. So lower rate over here is 15% plus present value interest factor at lower rate, which is 50%, that is 3.3522, and payback period is, we know that 3.3333. we are taking here 4 digit after decimal. Then present value interest factor at lower rate, again 3.3522, and present value interest factor as higher rate is 3.2743 multiplied by 16 minus 15. So if we calculate all of this, we get the value of 15.24%. So that means the IRR rate is 15.24 for project A. This calculation is straightforward because there is a even number of cash flow for project. Now for the project B, as we know that the cash flow is different, 1000 in year 1, 2000 in year 2, and so on. So in this case, this is uneven cash flow of project. Now let's follow this step. Step 1, calculation of fake payback period. Calculation of fake payback period, that is still fake annuity is equal to total cash flow over project life divided by project life. So that means total cash flow over project life is, let's simply add up all of this amount. 1,000 pound, 2,000 pound, 3,000 pound plus 5,000 pound plus 6,000 pound, and project life is, we know that 5 year, that we 17,000, and number of years 5 years. In this way we get 3,400 per year. And fake payback period, that means again over here we'll use the formula for initial cost divided by annual CF method here. So initial cost is, we know that project B also pound 10,000, then annual cost cash flow is 3,400. In this way we get the fake payback period of 2.9412. Step 2, finding discount rate at trial. Finding discount rate at trial, that means if you look in the financial table, the present value interest factor, this 2.9412 year with a number of years 5, you will get the value. This 2.9412 lies between